Mutual funds have long been one of the go-to options for investors seeking income, diversification, and professional management. But when it comes to generating monthly income, the question that keeps cropping up is simple. Is yield the key? At first glance, the answer seems obvious. After all, mutual funds often advertise their dividend yield, and a higher yield promises more income, right? Well, the reality is far more nuanced, and understanding it could be the difference between a steady stream of cash and a portfolio that disappoints when you need it most. To start, it's important to define what we mean by yield in mutual funds. Yield is essentially the annual income you earn from a fund, interest, dividends, or other payouts, divided by the fund's current price. It's expressed as a percentage, and it's what most investors look at first when comparing funds. If Fund A has a yield of 6% and Fund B only 3%, it's tempting to assume Fund A will deliver double the monthly income, but here's the twist. A higher yield doesn't automatically mean a better or safer investment. One of the first things investors often overlook is that yield can be misleading. In mutual funds, especially bond or income-focused equity funds, yield can spike when the underlying securities are struggling. Imagine a bond fund holding bonds that are falling in price. The income generated may remain stable, but as the price drops, the yield percentage rises. At first, this looks attractive, until you realize that the fund's value has dropped, which could offset your gains or even erode your principal if you need to redeem units. In other words, chasing high yield without understanding the underlying risk is a classic mistake. So if yield alone isn't the whole story, what actually drives monthly income from mutual funds? The answer lies in two key areas: dividend and interest payments, and fund structure. Some funds are designed specifically to pay regular monthly or quarterly distributions, often called income funds or monthly dividend funds. These funds generate cash by investing in bonds, high-dividend stocks, or other income-producing instruments. The frequency and consistency of these distributions matter more than the headline yield alone. A fund that pays consistently every month may be far more valuable for a retiree or income-frequent investor than a fund with a high but irregular yield. Another important factor is expense ratio and management fees. Every mutual fund charges fees, and they come out of the fund's earnings. High fees can eat into the income you receive, and if a fund uses aggressive strategies to boost yield, like leveraging or investing in riskier securities, the risk-adjusted return may not be worth it. Investors seeking stable monthly income need to balance yield with fund quality, diversification, and fees. High yield is enticing, but too much focus on it can lead to chasing risky funds that underperform when the market turns. Now let's talk about types of funds that are most suitable for monthly income. Bond funds are a natural fit because they earn interest regularly, and many distribute it monthly to investors. Corporate bond funds, government bond funds, and short-term bond funds are popular choices. Equity dividend funds can also provide monthly or quarterly income, though the payouts depend on company dividends, which can fluctuate with earnings and economic conditions. Balanced funds, which hold a mix of equities and bonds, may offer moderate monthly income while also providing potential growth, helpful for investors worried about inflation eroding their purchasing power over time. One strategy that many income funkies investors use is to combine multiple funds with staggered payout schedules. By holding a mix of funds that distribute income at different times, you can create a smoother monthly cash flow. For instance, one fund may pay in January, April, July, and October, while another pays in February, May, August, and November. The result is almost like having a paycheck from your portfolio each month. This approach also reduces reliance on a single fund or asset class, spreading risk and improving consistency. Here's where a subtle but critical point comes in. Total return matters more than yield alone. A fund may offer 7% yield, but if its net asset value, NAV, is falling due to market fluctuations, your actual returns could be negative when measured in cash or long-term growth. Conversely, a fund with a modest 3–4% yield but stable or rising NAV may generate far better wealth over time while still providing reliable monthly income. Investors often overlook this, focusing solely on headline numbers without digging into performance history, portfolio quality, and risk exposure. Tax implications are another twist that investors can't ignore. Distributions from mutual funds are typically taxed as interest or dividend income, and the rates can differ depending on your country's tax code. Monthly income investors need to account for this when calculating how much they'll actually receive. Ignoring taxes can make a seemingly attractive yield far less appealing in practice. Another layer to consider is the reinvestment option. Many funds allow dividends to be reinvested automatically, which compounds your returns over time but reduces immediate cash flow. For those relying on monthly income, you'd likely want distributions paid out rather than reinvested. But for long-term investors, reinvesting can significantly boost overall wealth. Balancing these choices, immediate income versus compounding growth, is central to a sound strategy. So, is yield the key to monthly income from mutual funds? The answer is yes and no. Yield provides a snapshot of income potential, but stability, consistency, and risk-adjusted returns are the true drivers of reliable cash flow. Investors should evaluate the underlying assets, distribution schedule, fees, taxes, and historical performance, rather than chasing the highest yield on paper. A slightly lower-yielding fund with predictable monthly payouts, strong fundamentals, and low fees may deliver far more reliable income than a fund that promises double-digit yields but carries high risk. For those looking to optimize monthly income, a few practical steps can make a huge difference. First, screen for funds with a long history of consistent distributions, ideally paying monthly or quarterly. Second, diversify across asset classes, combining bond funds, equity dividend funds, and balanced funds to spread risk. Third, pay attention to the payout ratio and NAV stability. Funds relying on capital gains to pay distributions may offer high yield temporarily, but these payouts are unsustainable if the market dips. Fourth, factor in taxation and reinvestment strategies to ensure your monthly income meets your actual spending needs. It's also worth noting that in today's environment of low interest rates and market volatility, investors may need to adjust expectations. Monthly income from mutual funds may not replace a full paycheck, but when structured thoughtfully, it can supplement income, cover essential expenses, and even provide a buffer during market downturns. Many retirees and part-time income seekers use mutual funds as a core part of a multi-layered income strategy, combining them with pensions, Social Security, or rental income to build a comprehensive cash flow plan. In short, monthly income from mutual funds isn't just about chasing the highest yield. It's about building a portfolio that delivers consistency, protects capital, and aligns with your lifestyle goals. When approached strategically, mutual funds can be a powerful tool, turning small investments into steady streams of cash that grow over time, while also giving you exposure to diversified professional management. If you want to start generating monthly income from mutual funds, the key takeaway is simple. Look beyond the headline yield, focus on stability, diversify wisely, and monitor your fund's fundamentals regularly. By doing so, you can build a portfolio that not only pays you each month, but also protects your wealth for the long term. So if this guide helped you understand how to generate reliable monthly income from mutual funds, make sure to hit like, subscribe, and turn on the notification bell. We cover more strategies, tips, and secrets to make your money work for you, and you don't want to miss the next video on creating consistent cash flow while protecting your investments. Remember, in investing, knowledge and strategy are always the real keys to income, not just chasing the numbers on a screen.